In this video, I am going to talk all about what I consider to be the key considerations as to whether an exchange-traded fund is going to be a saleable product. My name is Corey Hoffstein. I am the CEO and CIO of Newfound Research, as well as the co-founder and portfolio manager of return-stacked ETFs. This presentation, first and foremost, are solely my views, not the views of Newfound or return-stacked ETFs, but it embeds all of my experience, the experience I have pre my most recent ETF suite, as well as the ideas we've incorporated into the most recent ETF suite, which we launched in Feb 2023 and has grown to over $800 million in assets under management in the 20 months since. The idea behind this presentation, which is really a follow-up to the first presentation I did on launching ETFs and the business and costs behind it, is to evaluate whether an ETF is ultimately saleable. And again, these are things that I've come to consider as being important ideas. A lot of this can be summed up in a quote I heard on a Patrick O'Shaughnessy Invest Like the Best podcast. His guest was Eric Serrano. This is the title of the episode, Investing in Investment Firms. I would highly recommend anyone who's thinking about launching an asset manager, go listen to this episode. There's a lot of brilliant thoughts. But I thought Patrick summed it up perfectly with this quote, which was, a strategy as a product is more than a series of returns. And I think a lot of us who come into this industry as passionate investors overlook this idea to our detriment when it comes to building investment products. We focus too much on the investment side and not enough recognition of the fact that these are products. And that requires us thinking about product market fit. Product market fit ultimately entails figuring out who our product is for and what problem we are trying to solve for them. Again, those of us who come from the investment side are all too guilty simply of thinking about what makes the best return series, and that's actually not always what makes the best investment product. Now, one of the things we have to consider first is who our buyer is. Different buyers will have different needs and wants in a product design. And so before we bring a product to market, we want to think about who ultimately is going to be the end user and how they think about building portfolios and what their sensitivities are and what their needs are, right? Are we talking about people who are the principals that are making the investment decisions or agents that are acting? How sophisticated is our buyer? How much tolerance do they have for complexity? What's their understanding? How do they make investment decisions? What are their key considerations? How many decision makers are there? Is there a sole decision maker, or is this decision by committee where politics are going to come into play? You need to consider whether these are people making short-term trades, long-term asset allocations, designing model portfolios. All of those change how people think about building and using products. And ultimately, what are they trying to get out of an investment? What is the purpose? Ultimately, who are we selling to? And once we have that avatar, it's equally important to consider what the value proposition of our product is. Most people just think of value proposition being the returns, right? What is hopefully trying to beat the benchmark, but that's not the only value proposition people care about. And that's shown dramatically when you study where flows go in the industry, right? Performance does matter. Outperformance is certainly a valuable value proposition, but other value propositions might include things like risk management, right? People put a significant degree of value on protecting the downside. There's also products that provide a specialized focus or customization, whether that's something like ESG or some sort of religious tilt to the product, right? There can be customizations that are important to an investor that makes them choose your product. There's ease and convenience. This one, I think the best example is dividend yield products. Objectively, dividend yield, or high dividend yield specifically, is just a bad value implementation. And yet there's a tremendous amount of flow into that space because investors value receiving a large dividend check in their portfolio, despite the fact they could ultimately achieve the same thing by just selling shares and synthetically constructing that dividend. They don't like to do that. That's too much effort. They like the ease of just receiving a high dividend. And so dividend yield products get a lot of flow. Ease and convenience is the value proposition. Access to a new asset class, different types of support, right? You might, as a firm, offer generic products, but if you go above and beyond for your clients, right, that's unique. DFA, for example, there was support, obviously, and they had a strong performance value proposition and a research value proposition, but by allowing advisors to say that they were the exclusive party that could use DFA funds in their neighborhood, it gave those advisors a marketing advantage, right? That's a value proposition of using those products. And then finally, cost, right? Being lower cost than other parties is a value proposition in and of itself. Ultimately, what we're talking about here is benefits of owning the product, not the features of the product. And I think that's a critical difference. If your value proposition is a feature of your fund, I think you're looking at it wrong. You need to consider what the benefits are to the end investor. And ideally, those benefits have to line up with that buyer avatar. So let's talk about some of the frictions we hit. Let's assume you have your buyer avatar, you have your value proposition. What are some of the other frictions that you might hit in the saleability of this product? And again, this is all just based on my experience. What I see when it comes to implementation is the biggest problem we hit is what I call the funding problem, which is when you're asking an allocator to buy your fund, you are implicitly asking them to sell something else. And there's all sorts of considerations that go into that. What I have on this page is quite simply the average equity allocation among world allocators. In other words, just the passive market cap weights of equity markets. And what we can see is that US large cap currently dominates, which means on average, if you're talking to an investor or an allocator, they're going to have a much larger slice of US large cap exposure in their portfolio than they are of, say, EFI mid cap, small mid cap, right? And so if you're bringing a fund to market, it's important to consider what space an allocator actually has in their portfolio and how much brain damage they want to go through in order to understand your fund and how it's going to fit in their allocation framework. If you're talking about having a great EFI mid cap fund and they're running a 60-40, and EFI mid cap is 7% of that 60, is it really going to move the needle for them versus them spending their time on a larger allocation to an interesting US large cap fund? So you need to consider this funding problem. And this funding problem sort of manifests in several ways. One thing to consider, for example, is category flows. And there's a huge cyclicality here. If you're bringing a product to market, it's important to understand, for example, that large cap funds over the last year have had north of, call it, $80 billion in inflows, whereas small cap funds have been net flows flat. So if you're trying to take a small cap fund and you want to raise $5 billion in a small cap fund, I think it's worth acknowledging there's been a total of $20 billion in flow, net flow being zero. You would have had to have been a quarter of the flow and half of the positive flow to go from 0 to 5 billion in a year. There's just not that much money moving. And so again, you're talking about this funding problem where small cap US equity just isn't a big category that a lot of investors care about right now. But this cuts both ways, right? Yes, there's a larger slice of the pie that is US large cap, but it also means you have a lot more competition, right? Commodities very out of favor today. There's still a decent amount of assets there, $188 billion. You know, there's the question you need to play, which is, do I want to launch yet another large cap equity fund, knowing that everyone you talk to has large cap equity access, but it also means that's the bloodiest part of the ocean. You're competing against everyone else. So you need to balance these two things in your mind of how are people building their portfolios? What sort of buckets are they looking at? And then what's my real opportunity there? How much am I fighting with everyone else? In my experience, US allocators tend to think of things as US large cap, US mid-small, that's sort of one bucket, foreign developed, and emerging markets. Those are your four equity buckets that matter. If you're not falling neatly into one of those equity buckets, you're creating more friction for your product to be sold into their portfolio. And this friction to me is why you don't see a lot of global equity funds. I get asked all the time, Corey, can you launch more global funds? My simple answer is, to me, it's just not a good value proposition. When you look at, say, foreign versus global flows, foreign dominates global. And part of my explanation for this is, one, it's not naturally how people think about allocating their buckets. One of the examples is I actually ran a global equity fund in the mid 2010s. And I was on a large bank platform, and those advisors, when they went to look for funds, would look within categories. And they didn't have a global equity category. They had a US, a foreign developed, and an emerging market. It just, global was this thing people didn't think about. And part of the problem is when allocators are already working within that other framework, me saying, come buy my global equity fund requires them to sell US equity, foreign developed, and emerging markets. So they need to make 3 sales to make room for my one fund. And then as they're thinking about rebalancing their portfolio, they have to do the extra legwork to x-ray into my fund to see what the global equity allocation breakdown is and how that's influencing their overall allocation. So I'm creating a tremendous amount more work for that allocator versus them keeping those silos neat and clean. And I think that's why you just don't see global equity funds being a large driver of flow, and why I often suggest to people, or I will say, I really don't want to launch global equity funds for the most part. Similarly, multi-asset funds, and this is one people pitch me multi-asset funds all the time, funds that are going to include stocks and bonds and commodities and all these interesting ideas. But if you look at where flows go and where AUM is, it's not in multi-asset funds. Because again, if I bring a multi-asset fund to market, now an allocator needs to make room in their portfolio by selling stocks, bonds, all these other things to make room. They need to make sure they sell them in the right proportion for what you're doing within that fund. And then when they go to rebalance, they need to consider, right, x-raying into your fund, what are you actually giving them at any given time? And if they happen to get whatever they sold wrong in the mixture, it can really upset their asset allocation. So what we just tend to see is multi-asset funds are not successful generally in raising assets. There are always exceptions, but by and large, most asset allocators, most consultants, most institutions work in a very bucketed framework. And if you start to blur the lines between buckets, not only are you asking them to do more work and execute more trades to incorporate your portfolio, but you're taking part of their job away, which is the asset allocation. And so I think the flows and the data supports that these are just not popular fund choices because of the way people buy product. The phrase we kick around a lot is maximum impact for minimum disruption. If someone's going to buy my fund, one of the questions I want to ask is how many trades does it take for them to implement the strategy? Ideally, it's 1 sell to make room, 1 buy for my fund. The more sales they have to make room, right? If you're selling a global equity fund and you're asking someone to sell some US large cap, some foreign developed, and some EM to make room, you've now asked them to make 3 sales for 1 purchase, right? That's not minimum disruption. And then you have to ask your fund, when after they do that trade, whatever your fund is holding, how much tracking error are you introducing? How much complexity are you creating? How much mental horsepower does the allocator have to use to understand and remember, right? Not just understand when they put the trade on, but remember and recall over the next 3, 6, 12 months, 18 months, 36 months, how to appropriately benchmark you and when and how you're supposed to perform. And the more complicated that trade, the more things you ask them to sell to make room for your product, I tend to find the more mental horsepower you're asking that advisor or that allocator to use just to keep you in the portfolio. And so you have to have a really convincing value proposition, because to me, that mental horsepower creates a higher hurdle rate. It's also communication frictions that we need to consider when thinking about building a product. Often when I meet with boutiques, or boutiques happen to reach out to me about different product ideas, they tend to be more complex, not less complex. And my evolving view has become complexity simply creates more reasons for an allocator to say no. Ultimately, the most complex part of your process that you have to explain is going to be the bottleneck for your sale. If your product requires an allocator to understand option theory, then you're going to dramatically limit the number of potential buyers. Similarly, the number of things you have to explain for someone to understand how your product works, the higher that number, to me, the more exponentially difficult the sale becomes. You're giving someone more reasons to say no. So if your product does X and Y and Z, you've now given an allocator 3 reasons for which they could say no. And if they say no to any one of those reasons, your product is out of the running, right? So as an example, lately put spread collar concepts, buffered ETFs have been really, really popular, right? This is where you buy downside protection using options and then sell a call on the upside to make that a zero cost collar. And let's say you implement that with, I'm just going to buy the S&P 500 and put this put spread collar. Now all you need an investor to understand is how does the put spread collar work? And that's it, right? They're getting their passive equity beta. Compare that to a product where you say, I'm going to buy value stocks and overlay it with a put spread collar. Well, now you need someone to understand how a put spread collar works. They need to understand how your value stock selection model works, and they have to like value stocks. And they have to be willing to accept the tracking error of your value stock selection to the S&P 500, which is probably the beta that they care about. You've created a second thing for them to consider. And they might love the put spread collar idea and still say no to the value stocks, right? Now, maybe the value stocks is your core differentiation versus someone else. And maybe that niche approach allows you to get more enthusiastic buyers. But again, every time you say and in terms of what your product does, you're giving someone another reason to say no. We also have to consider that this industry is typically distributed through a game of telephone, right? Portfolio managers and researchers build product. They then explain it to wholesalers, who then explain it to advisors, who then have to explain it to investors. Or you have to explain it as an asset manager to a consultant, who has to explain it to an institution, who has to explain it to their stakeholders, right? Typically, there's 3 or 4 levels of this game of telephone, and the more complex your product is, the more likely that it's going to be misexplained, and the end stakeholder is going to have a misunderstanding of how it works and when it should work. The reality is most people won't have to explain the product to their end stakeholders or investors, whether it's an institution or an advisor investing on behalf of their clients. They typically don't actually have to explain it, but they're deathly afraid they will. And so they want to make sure they can understand and explain it if it's ever brought up to them and a client is asking, why do I own this? And by the way, the only reason most clients are asking, why do I own this, is because it's sticking out in a negative way. And so they need to be able to simply explain both why it's supposed to work and how it's supposed to work. And if you can't provide them a simple 1-sentence explanation of how it works and what the benefits are, that game of telephone can get very, very complicated, and it's going to be very hard for that end party to explain to the stakeholders, ultimately with conviction, why they should stay in it. And they're going to be much more likely to fire you than risk getting fired. And so again, simplicity in communication ties right into product design. And sometimes products are stickier when they are simpler, even if that leads to suboptimal investment design. And again, I think this is sometimes hard for those of us who come purely from the investment and research side. Fund products that raise the most assets are not always the most optimally designed from an investment perspective. That's all I think true, and yet it's all dwarfed by your value proposition. If your value proposition is big enough, exactly how your product works can sort of be swept under the rug. And I think a great example here was the recently launched box ETF. This is from my friends at Alpha Architect. This is a product that uses box spreads to create a return stream that's going to effectively look like T-bills, hopefully T-bills plus, based on options market financing rates, embedded financing rates. But they do some very clever things within how they manage that product to try to get it to be to use the create redemption mechanism to try to effectively wash out any realized taxes, which means hopefully for an investor, you're able to get T-bill-like behavior, but if you hold it, you can get long-term cap gains instead of ordinary income. That's an incredibly valuable value proposition to a lot of people who are sitting on cash. And yet I would guess that the vast majority of dollars in that fund could not explain to you the exact things that are actually happening within that fund. And that doesn't mean ETF Architect doesn't try to explain it and explain it well, but it's not trivial. The reality is the value proposition is so big, in my opinion, most people are willing to overlook the implementation details. They just care about the end result, and it's why that fund has gone from zero to several billion dollars so quickly. Other frictions that matter, fee frictions, right? Look, the reality is if you are launching your first fund, you need to be very realistic about your business profitability. You can't just launch a fund at very low fees. You need to understand the costs that go into running the business. Again, go back and see my first video. It's not just the startup ETF costs, it's the cost of running your business along with the startup ETF costs. And your profit margins that you need to run your business at are going to be directly driven, or at least partially driven, by the volatility of your product, the volatility of your AUM. You're generating revenue on AUM. If you're running a small cap value fund, you're going to have a lot more volatility than if you're running a short-term bond fund, right? And so you're going to need a much wider profit margin because your AUM volatility is going to be a lot higher in the small cap value fund than if you were running something more stable, and therefore your revenue volatility is going to be a lot higher. So you need to bake that into your fee. That said, if your fee is really high, it is going to be a big penalty factor in your Morningstar rating, and that matters. Most investors are going to look up your fund on Morningstar, and Morningstar's, in the first 3 years especially, fee is pretty much going to outweigh anything else. And so if you are way too high a fee for your category, you are going to end up with a negative rating in Morningstar, and it's going to look bad. And so you need to be aware of that. Ultimately, though, when talking to allocators, sort of the formula I've thought about is like your fee is equal parts your value proposition, the uniqueness of your value proposition in the market, and your brand strength. And those are all positive contributors. If your brand is really weak, right, it's not going to help you. If your brand is really strong, you can get away with charging a higher fee. If your product is really unique, it's the only one in the market, your fee can be egregious, right? Think of the Grayscale Bitcoin Trust. That was the first way for most people to get Bitcoin for a long time. It was trading at a ridiculous fee until all the Bitcoin ETFs were approved, and those are mostly waiving fees at 0 basis points now. So it's a race towards zero. But for the many, many years, it was really the only offering. Its uniqueness allowed it to have a really high fee because the value proposition was there. It allowed people to get Bitcoin access in their brokerage account when there was no other way prior to that. So all of this is sort of, they're different levers. The more generic, the more similar you are to things in the market, the less your value proposition really differs, the more your brand is going to matter in terms of being able to charge a fee. The other thing that really matters here, and I'm not going to go into the math, but you should pause and probably look at this slide, is you have to make sure that you are doing the active share math, that you look at your fee and you look at how active your portfolio is relative to its benchmark, and you're backing out your implied active fee and understanding what your actual hurdle rate is for the excess returns you need to generate before an investor gets any benefit. Now, this is more driven by strategies where your value proposition is explicitly excess returns above a benchmark. That's not true for every value proposition. But it's important to know and back out this math, because I've seen cases where people come to market with a high fee strategy. They're not active enough, and the implied excess returns that they have to overcome are 300 to 400 basis points per year before the investor can even benefit. And at that point, you might as well not even come to market with a product, because there's no way you're going to succeed. I want to talk about performance now, because at the end of the day, even though your value proposition isn't always performance, performance does matter. People will look at performance. Performance creates behavioral frictions. If an allocator's stakeholder points to your fund during some sort of performance review, it's normally not for good reasons. Normally, you're standing out negative. That creates a friction. Again, that allocator is more likely to fire you than risk losing that stakeholder as a client. And your weird behavior can be underperformance. It could just be high volatility, high tracking error, even low correlation to stocks and bonds, even though we would often pitch that as a diversification benefit. If stocks and bonds are doing really well and your fund is uncorrelated and just sort of meandering along, that can stick out in a negative way. And those are things to think about, right? Again, you're talking about this game of telephone. When it's 2 or 3 steps away from you and someone's trying to defend why your fund is in the portfolio, your value proposition has to be really, really strong, the weirder the behavior of your strategy is. What I tend to find in my experience is that after launching a fund, your first 6 to 12 months, you kind of can have your performance ignored. As long as it's not behaving too erratically to the upside or downside, there's a grace period here where most allocators will focus on process and people. 12 to 18 months in, what's going to happen is people are going to start pulling up your ticker, looking at Morningstar, seeing how you compare to your category, and it's going to begin impacting asset gathering to a more significant degree. 36 months in, performance is going to be a huge overlay in your ability to raise assets. Doesn't mean you have to have positive alpha. It just means if you are massively underperforming or you are miscategorized on Morningstar, you need to change categories to make sure you don't look bad, because that performance is going to be a silent no. Someone might love the process. They go look it up. They see an equity curve that looks totally different than the category, and they just sort of go cold on you. And the silent no is just the performance. Unfortunately, for those of us who work in this industry, we know 36 months really is not an appropriate amount of time to measure whether a strategy is working or not, especially the types of strategies, lower Sharpe strategies, lower information ratio strategies that can be put in a mutual fund or ETF. Doesn't stop people from tracking these things on sort of a rolling 36-month basis. And ultimately, in the absence of understanding, performance is the only measurable output of your process. Performance does matter over the long run, right? You can't keep saying, oh, my performance doesn't matter. It does matter, but it especially matters when nobody understands what you're doing. So again, the more complex your product is, the more important realized performance is going to be for the end investor. So my final thoughts here, putting this all together, I think I made the mistake early in my career, not thinking enough about investment strategies as products and thinking them like products in any other industry where we need to think about product market fit. One of the things we've tried to change as we brought our new suite of products to market is who is our buyer, right? And what is our value proposition? And then thinking through the complexity that we are putting in the products and whether we think that's part of the value proposition or whether we think that's just creating another friction point in the point of sale. I think it's proven to be helpful, and one of the reasons we've been able to raise assets as quickly as we have. By no means, is that evidence or proof that this is the right way of thinking, but it's been my experience in consulting with a lot of folks who are talking about bringing ETFs to market that they're solely thinking about this as an investment strategy and not spending enough time thinking about it as a standalone product. What I would really urge you to do if you're considering bringing an ETF to market is take a step back. Don't think about all the whiz-bang details and the interesting investment numbers. Don't look at the Sharpe ratios and the drawdown profiles and the Sortino. Take a step back and write out who is the buyer, why are they buying, what's the value proposition. Not what are the features, what are the benefits that you're trying to deliver, and think of it as that sort of packaging. And I think it will help you considerably in trying to determine ultimately the saleability of the product to allocators. Hope you enjoyed. If you have any questions, please feel free to leave comments, reach out. You can find me on Twitter @CHofstein.